Hey traders, Ragi here. Let's tackle a few bigger picture ideas here to start off our day, to start off our week with our premium video. And one is a tweet that I read that I thought was so good from a friend of mine, Anne Marie. And it reads simply this: if you stop watching the news, you will see what is happening much more clearly. And I think there is some truth to this right now. Now, when I say news, I'm not talking about data releases in the calendar. I'm not talking about even understanding how that data affects macroeconomics. That's not news, gang. That's macro in terms of a photographic lens and a big picture view of what's going on. But macroeconomics is not news, and news is not necessarily macroeconomics unless it affects the data points that on a rate of change basis slowly influence which stage of the macroeconomic cycle we're in. All right. So if you stop watching the news, you will see what is happening much more clearly. I'm not watching the news all that much. In fact, it's on a screen way off to my left, kind of off in the corner of my eye. I've got to turn my head to actually see what's happening on, as my mother has called the television my entire life, the dumb box. Okay. Now that's the first thing I want to leave, kind of, hopefully it leaves an impression. The other part is this is straight from Forex Live. And while I won't say this is a speculative storm and all this kind of stuff, I mean, this is very much how 2001 set up, where all of a sudden day trading shops had propped up all over the country. People were quitting their jobs and they became day traders. And then all those folks, after the implosion of the market, went back home. And this fits something that I have said, and it sounds very harsh, but it's so true, and a lot of folks forget, and that is this: do not confuse an uptrend with brains. Okay, it's a very old saying, but it's so true. Do not confuse. I don't know. I think maybe Confucius said it. I'm kidding, but really, it's a very old saying. Do not confuse an uptrend with brains. And I think what's happening is two things. This is like I said, an article from Forex Live, which is well worth a quick look-see. And it's the trend that's accelerating, where you've got retail clients opening record funded accounts in the first quarter. Okay. And so you've got net gains at E-Trade. You've got net gains of brand new funded accounts at Ameritrade. Hey, I'm happy for traders to be entering the market. In fact, that is my mission, to get people to understand the markets and empower themselves. But if people are just running into the markets because they've got nothing better to do and they're not accompanying these funded accounts with education, this ends badly. And this is exactly the way 2000, late 2000 started looking. Everybody was a day trader. Okay. So very interesting when you read this article. And this is probably the most shocking part of it right here. And that is, this is from TD Ameritrade. The average client trades since what? Since commissions went to zero. Did we suddenly find that many more great trades? Or suddenly is the barrier, or at least a perceived barrier to trades, now lower because people figure, well, it's not costing me a commission? I think it can encourage some traders to trade more actively because your cost per trade is low. Therefore, you can get in and out with more frequency, but that should not be a strategy. In other words, zero commissions should not be a strategy. It should actually make your strategy more profitable. So I'm sure some of those folks are in that window, but I'd say a lot of it has to do with a lot of time on people's hands, a market that continues to bounce with a lot of ballyhoo on financial media, and zero commissions. And it's creating a very 2000-esque bubble. And that's really what Forex Live pointed out. And I thought that was really worth mentioning. And yeah, there's a lot of merit to that, gang. There's a lot of merit to that. All right. So moving on to a topic that I discussed in the free video, and that is the fact that we could probably make a pretty good argument for long positions in the NASDAQ. And I'm not necessarily wanting to get in at these highs, but when we pull back to the wave, when we pull back to the 34 EMA on the high and the 21 EMA, the 21 EMA propulsion dots, yeah, there's a pretty good validity for potentially wanting to build a long position. And that long position can extend to XLY, and XLC on those pullbacks. XLY is particularly interesting because two stocks that have done very well and two stocks that are double green within the XLY are heavily weighted, right? Dollar General and Amazon are pretty interesting to me. So XLY itself is a buy, as are Amazon and Dollar General on pullback buys. Again, double green. That's what we're looking at right here. That great double green right there. So you might ask, well, what about XLC, Rog? What about the XLC and pullbacks on that? I'd like to see a deeper pullback on XLC. And if XLC does pull back, I would look for potential pullback buys on Facebook, on Charter, on Netflix, but there's three names that pop out, and you're probably seeing them right now because of the trade flags. Netflix, Activision, and EA. Okay? Those would be my three preferred names on a pullback in the XLC. So again, why does XLC come up? Heavily weighted name within the NASDAQ. Heavily weighted sector within the NASDAQ, and these stocks are heavily weighted within the XLC. So we'll be keeping an eye on these, possibly for some bullish setups. And, one of the things that I left, in terms of discussion in the free video was, waking up and just kind of asking yourself out of the box questions like, would it be ridiculous if the NASDAQ is actually heading higher for a little while? Would it be ridiculous if the heavily weighted sectors within the NASDAQ go and the double green stocks within those sectors go higher? So again, don't be afraid to ask that. We'll do a whole lot more of that in the morning along with our day trading. So the next is looking at the RBOB. And I still like the short position in RBOB. I still like the short position in crude oil. And I would encourage most traders to focus on RBOB mostly, just to navigate around the craziness in CL. I'm not recommending natural gas trades any longer. I'm not recommending USO trades any longer. Those have fallen off the list. But I really don't have an issue with getting short crude, by the way. But please stick with the futures options on this. We need to trade higher towards about 24, as you can see here. I'm going to show you when this pops back up again. I'm looking for something closer to the bottom line of the wave and 24. Yes, we've got the 21 EMA lit up, but at the end of the day, I'd like to have something closer to the wave. And remember, we do have some volatility events that could create higher highs in CL. We've got the API private inventory number tomorrow after the close, 4:30 p.m. Eastern. And we have Wednesday's EIA release at 10:30 a.m. So I do like the shorts in crude. But let me show you the difference in dollars as far as, I think this is relevant to why I would recommend waiting. Okay, so here we have no, that's not what I want to do. Let's see if I can get this line to move. Here we go. So this would be a short from that area. That's a $7,200 approximate risk, right? But look, if we get to this area, 4,700, 4,600. We get to the middle line of the wave, it's 3,100. We get to one of these V-score lines right there. Take a peek. Now it's 1,700. Now the best way to be able to capitalize on this would be to, I believe, at these aggro levels, focus on puts in crude. And I do like the puts in RBOB futures as well. And so the next question then becomes, well, Rog, which puts? So if you go to the RBOB futures chain, you're really going to want to go out to, there's not a lot of volatility here, by the way. There's not a lot of volume here in the RBOB, unfortunately. That's, kind of an issue. You're going to end up wanting to be no closer than July, all right? And you're going to want to look at the puts in July, and it's really slim pickings, okay? That's one of the issues. So then you say, well, Rog, the options chain looks like crickets and tumbleweeds. What about going out into UGA? UGA does look a little bit better. This would be the UGA ETF, and you would go out to June 19, or even take a look at July. And I like there's some good put action on the July contract, and you're looking specifically, not great, okay, you're looking specifically at the 13 to 14 puts, those strikes, and they're relatively inexpensive, but there's also, remember, this is a $13, $14 ETF. So you're talking about $2.15 for the 14s, puts for July, $1.70 for the puts for the 13s in July. So 14s are going at $2.15, 13s are going at $1.70. So as we move higher into the wave, those UGA puts might be an interesting way to play the short in RBOB as opposed to going into the underlying futures contract. And this is something that a lot of traders express to me, which is, Rog, if we're going to take something overnight, if we're not day trading, what are the ETF alternatives? What are the options alternatives? That's where I feel a whole lot more comfortable in these longer term kind of overnight risk type scenarios. All right. And I'm totally fine with that. I get it. I think that heating oil could also be in another market to watch. And by the way, they're not terribly expensive, but this is a $5,200 contract per contract, right? Heating oil, nice downtrend. I'd love to short heating oil on a rally to the 21. Absolutely would love to do that. And this is another $5,200 contract. So oftentimes the options are going to, one, tie up less margin, two, clearly be a little bit less risk. All right, so finally, we're going to dive into some prep for tomorrow's day trading session with me, Tuesday, Wednesday, and Thursdays. I do the morning session in the room. So let's go over some notes here. So these are some of the notes, and we're going to go over this in detail tomorrow. You'll see me put this to work in the room. But what do we start with? I'm less interested that you go through this in a chronological order, but this is pretty much the chronological order in my mind, and this is it. Is there a gap today? We're going to look at the difference between the 4 p.m. Eastern close and the 9:30 open. And yes, I am open to some day trades between 7 a.m. Eastern and about 9-ish. I'm open to that 2 hours, that pre-market 2 hours, which actually sometimes can be better than what we get after the bell. But if there's a gap like there was today, that gap psychology is going to be dominant in terms of the strategies and what we'll be looking for. Is it a caution day? Non-farm payroll, FOMC, end of month, end of quarter, options expiration, heavily weighted stocks earnings. Those are the things that we'll also be looking at in terms of making the day possibly a little bit more unpredictable, a little bit more volatile, etc. Is it a caution day? We can pass. In other words, on a caution day, you can choose not to trade at all. You can also choose to trade primarily options or minis, micros, and smaller size, right? So that's how we would respond and trade a caution day. Then we're going to go take a look at our risk on, risk off barometer, as I like to say. And that barometer is the yen. It is the Aussie, the New Zealand dollar, and Canadian dollar. All the COM dollars, quite frankly, with more focus on Japanese yen and Australian dollar. Bonds, that's the ZB, VIX, and lately we got to keep an eye on crude oil. Crude tore higher, and you got to wonder if that was partly the reason we saw some strength in equities. So you got to look at those barometers. So textbook risk on, textbook risk off. This is, whether or not we'd see strength in equities or weakness in equities. So this would be risk on equities and indices, the equity indices strength, or whether we'd see equity and indices weakness, right? So this is how we look at risk on and risk off, all right, after we look at the barometer. What else do we look at? Trends and ranges after 9:30. So we have our trends and ranges between 2 and 9:30. We have those 2 and 9:30 ranges, and you can see down here V-score extremes, right? Trends and ranges. I think that's something we could kind of add in between or just in front of this, okay? But we also have what's happened between 9:30 and, here we go, 9:30 and 10. That's another thing we can keep an eye on, right? What can we look at before the open? Do we have proximity to any HPMRs? I update the HPMRs in the room every Monday morning, and we have our futures pack, Forex pack for the majors only. We have our ETF pack, and we have our stock pack. All right, you update those. They work on Thinkorswim. And so are we near an HPMR right at the open. Sometimes it's an early jump, an early opportunity as the bell rings, okay? So those are things you can look at. V-score extremes we talked about. Is there proximity to the HPMRs right around the open? Okay, so that's something else you want to keep an eye on. And you know, we also want to look at the directional bias of the morning. You know, do we have mostly green grab candles? Is the market trending higher after the open and giving us propulsion dots and so forth? And then there's the bigger picture initial balance. And what else could help with directional bias? I mean, clearly grab candles can help. Clearly where we are in terms of the relationship to the wave, which is going to print the color of the grab candles, that's going to help. Are we above or below the VWAP, right? That's another thing that's going to give us some insight. And these are all the things that I look for as I'm determining what, if anything, I want to do in the morning, all right? So we'll go through all that tomorrow. That's it for tonight's premium video, and I will see you all in the next update.